Welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio, and today we're kind of discussing the Very Good Food Company and the recent share dilution that has a lot of YouTubers angry. And also, we're going to kind of be giving our opinions on why they issued a lot of these shares, and then also too kind of a critique for a lot of the big YouTubers and what the big YouTubers have been doing, where apparently this stock has actually been paying people to promote this stock while they're kind of operating under the guise of an unbiased review. Now, to their credit, they do disclose that they are in a relationship with this particular company itself. However, we still here at Capital Mindset think that's highly unethical, and we also kind of have an absolute bone to pick with that. So before we kind of get into that, let's kind of explain why the Very Good Food Company did that huge share issuance as of late, Fabio, and then also too why they might be reaching out to YouTubers to have their stock promoted as well.
Yeah, there's a lot I could say here, but where I'm going to begin, so I'm more structured, is the belief or the complete lack of understanding that some individuals have about share dilution and the point of share dilution. Okay, so let's talk about it from the perspective of the CFO, right? And when I say that this is a point of aggravation, it's kind of an understatement. When I listen to what some individuals say out there about this topic, just goes to show that there are individuals who do not know what they're talking about. And a lot of people are assigning credence or assigning a title of great wisdom to these individuals, and they have no idea what they're talking about. So basically, a company or a CFO is one of their primary jobs is to acquire capital at the lowest cost possible. Now, there's two ways to acquire capital, Austin. What are they? Two basic ways.
You can acquire capital through debt, or you can acquire it through equity.
Exactly. Those are the two ways, debt or equity. And the debt has many different, that's an umbrella term. So there's many different ways of doing that. And then in equity, there's not many ways, but equity is usually just straight shares of the stock. And assuming that there's only one type of stock or one type of share. So with share issuance versus debt, a good CFO is judging whether or not they are going to issue debt or issue equity, in essence, raise capital to fund operations and grow the business. And they'll do so at the lowest cost. Now, sometimes that will be debt. Sometimes that will be equity. Now, if a CFO is a terrible CFO, they will use the more expensive way, okay, the more expensive capital raise opportunity. In this case, I guarantee you that there was probably it was probably cheaper to issue equity than it was to issue debt based on the financials of this company, based on the complete lack of cash flows. It's negative cash flows, and the cash flows are more negative than their revenue. Okay.
Yeah, and it's decreasing year over year as well, like pretty substantially, Fabio.
Yeah, so that's a problem. And you also have the fact that it is a relatively small company, unproven business model. You also have, so that's from the creditor side. So the creditors are probably going to demand a really high interest rate on that debt, or it's going to be very costly. So the CFO is looking at that and saying, well, that's not very attractive. Well, what about the equity? Well, equity, you're giving up future earnings because there's no need for payment in the now, right? If I'm giving up equity, I'm giving up future earnings potential through dilution, because now I have to share the pie with you or with new people who I'm selling the shares to, and I'm getting the cash, and then I don't have to give you a dividend. I don't have to do buybacks. I'm just sharing with you the future potential of those future earnings, right? So that's the cost of the equity for Very Good Food Company. So that was probably the lowest cost of equity. So a CFO will dilute, or the management will choose to dilute based on the lowest or the cheapest form of raising capital. So when people say that, oh, there's no need for this company to raise capital, that irks me a little bit, okay? Because that's not necessarily true. And you want your company to maximize the total shareholder returns. And sometimes that includes a little bit of share dilution here and there, because it's the cheapest form of acquiring capital in order to grow the business, because that's at the end what you want. And then you get into the discussion of, are those investments good? Okay, so that's two separate arguments. How do they get the capital? And then what are they doing with that capital? Two very separate arguments that you want to make sure both are good. Because if you have good investments, but terrible raising of capital, then you're going to have lackluster performance. But if you have optimal capital raise and then optimal investments in the business, then there you have the winning formula for a great business going forward.
Exactly. So that, yes, Fabio, sorry.
No. So just so everyone's aware. So next time you hear someone say that, oh, this company has a lot of cash or has a lot of cash flows and they're not going to dilute you, that's not necessarily the case. Okay. So that's what I want everyone to make sure they understand. That's not the case. Okay. That doesn't guarantee they won't dilute you.
And so something else that I kind of want to bring up too, Fabio, and it's in specific relation to another comment in that exact same video that was made. Why are you focusing so much on expanding in China? You should be focusing on your own product. Now, what that looks like to me personally, Fabio, is a distraction. Basically, what I'm seeing is
classic distraction. Yeah.
For lack of a better term, Fabio, in all seriousness, I'm seeing a failing business, basically distracting and expanding into these markets instead of reinvesting that back into their own products, specifically because of a distraction, Fabio.
Yes.
And so now the other interesting part too, is that there is a lot of talk on YouTube that the reason why they were reaching out to YouTubers was because they wanted to raise the share price. It's a small enough business that they could do that, Fabio. They wanted to raise the share price and then they wanted to issue equity. And then that inevitably will dilute shareholders. So that answers to what you were talking about earlier. Now, the other thing is we're not at liberty here at Capital Mindset to really be discussing if that's exactly what they did, because that's conjecture. But if you're a YouTuber and a company reaches out to you to make an analysis video on a particular stock, don't do it. Don't do it. Ryan Scribner, I'm looking at you. Don't do it.
Oh, we're dropping names.
Yes. Yes. Ryan Scribner, you are tarnishing your brand by doing this. Do not do this. You cannot say that they're paying you to make an analysis video and then suddenly say that your analysis is unbiased. Do you not see how that's a huge conflict of interest? All right. Yeah. Shame on you. Actually, shame on you. And I'm actually serious right now, Fabio. Shame on any YouTuber who's doing that kind of stuff, because basically what's happening is that you can't really be unbiased in instances like this. And then also too, if you're of the belief that the vegan craze, like the vegan movement and all of these specific companies that are trying to capitalize on that will turn into a large thing within the next 10 years, great, that's fine. You can have that opinion. However, Fabio, I wouldn't gamble my life savings away in unprofitable growth stocks. Just personally, that's just me personally. And so now kind of getting into this as well, what are kind of your opinions on the fact that these companies or any company in the future reaching out to YouTubers? What is your opinion on that, Fabio?
Well, actually, I just wanted to make sure, because you did do a name drop. So now I thought it was appropriate to show our audience this. So this is September 26, 2021. This is the fine, beautiful gentleman who, looks out for his viewers' interests. And this is, so remember, September 26, 2021, he does his review. Well, actually, I don't even want to know, but maybe these 5,926 individuals, have a lot of money to drop. And I think there were other people talking about the stock around the same time, because look what happened starting in around that same time period. Yeah, this big jump, about 33%. Now, this could be associated, I think, with their NASDAQ. Yeah, they're on the NASDAQ. That could be associated with that. And then just as that happened, they did the issuance. Boom. Right there. So that being said, what I'm trying to get at with that is this company is, well, I don't know, there's no other way to put it. It's a very bad company.
Yeah.
It's a very, 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 very bad company, no matter what way you put it. I'm not going to name drop this other individual, but there was an individual who said that, or was ranting about their share issuance. I think you sent me that video, and they were saying that the company's food was bad, but they invested in it. So they were angry about them issuing the shares. The financials were terrible and the food was bad, but they decided to invest. So I didn't understand. And I asked you that question. I said, what is this person's thesis? What is the driving factor? I don't understand.
They're also not selling either. They disclose that in their video. Now, case in point, Fabio, I actually do legitimately think in this instance that he wasn't exactly being paid by this, just based on the emotion that he really honestly showed with the share dilution. And now that kind of creates an interesting scenario too, because like exactly that, what's the logical reasoning behind investing into a company that you don't think their food tastes good, and then you don't like how management is running the business, Fabio? Which that's another thing, to be completely honest with you. I don't like the way this company conducts its business, to be completely honest. I don't think reaching out to YouTubers and misleading probably thousands of people into investing into this is a good strategy by management, personally, Fabio. And I'm also going to say this too. I think the managers are clowns, just being honest with you. Ooh. And and so I would absolutely never put my capital in this company, never. And I don't think that they're going to be in business for much longer, if I'm being completely honest with you, Fabio. So those are my opinions regarding the Very Good Food Company. Those are just my opinions. You might differ from me. That's completely fine if you differ from me. However, this is kind of where I'm operating with this. And you kind of see the emotion that I have behind this, because it's frankly just something that really irks me when people that have a lot of money, they've been saving a lot of money, the working class is misled by people that know they should say no, but don't otherwise. And that just bothers me, Fabio. But anyways, I'll get off my soapbox for a quick second. Let's kind of dive back into the numbers a little bit. What do you think is in store for the Very Good Food Company regarding the upcoming future performance? And then what are some things that they might need to do if they want to improve their performance as of right now, Fabio?
All right. So putting on the consulting hat here then. Well, first, apparently I haven't tasted their product, but if I'm going off of one of their strongest bulls, I guess, they got to fix the taste of the product before anything. And then we can talk about these operational efficiencies, because it appears so that their gross profits aren't very high relative to the revenue. And we're not even talking about the other expenses that are going to come into place. And if their product is bad and they're spending that much on the product, that's not a good sign. Okay, so we can kind of see here. I wanted to show this. This is what I was looking for. This is who they are benchmarking themselves. This is the company, right? So you can kind of see here some companies that we've talked about. TTCF. We haven't talked about Beyond Meat, but TTCF's been talked about on this. And I guess these are some different other entities we haven't talked about. Maybe some of these are funds, but they're trying to show that they're outperformance. I know that certain creators that were talking about this company around here, and we can take a look at what occurred and then where they are today. So there's not much to talk about in the financials other than it's pretty bad. The management is nothing to be impressed with. They are unproven. There's a lot of things that I would have to see before I would even consider. I would have to see proof of scale and proof that the customers are enjoying the product. I need to see that. I would probably have to taste it for myself, but more than that, I'd have to see that there's a huge community that says the products are really tasty. Because maybe I don't like it, but that doesn't mean it's a bad product. That just means maybe I'm weird, right? That could be the case. So I'd have to see it, one of those two things. Maybe I like it, and then maybe others don't like it. So then I have to be aware of that too. So in the counter scenario. But we kind of saw here Austin's very emotional side when it comes to these sorts of things. He I know in the past thought of Ryan Scribner as a decent creator who provided value, and Austin, I'll speak for him in this case because I can see it in his face. He's disappointed in what he became because he did think that he was someone who did provide value in the past to some extent, as far as he could have with the knowledge he had. So Austin is it's that quote, either die the hero or you live long enough.
Or you live long enough to see yourself become the villain.
Exactly. So we'll say this right here in this video. This channel will never, ever, 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 ever be sponsored by a stock that we will review.
No, never.
Okay.
Absolutely never. That will never happen.
That will never happen. Austin here can't if he sees fraud, oh my gosh.
Yeah. Now, we're not saying that they're committing fraud, but the same like emotional response that I have to fraud is pretty much the same emotional response I'm having now. So, you know,
I mean, if you are someone, let's say you're an analyst, you're a financial analyst, and your job is to analyze a business and come up with a price target from which pension funds will derive their decisions as to whether or not they'll invest. It is fraud for that analyst to provide that price target, having been paid by that company they're supposed to analyze.
Yeah,
that is the equivalent of doing an audit, at an accounting firm, and then having the company that you're supposed to audit pay you a lot of money under the table to give them a good audit review. It's the same thing. So Ryan is not, now that we're using his name, Ryan is not a financial analyst. He is a creator on YouTube. He's an individual who was paid. He did disclose it, which, to his credit, he disclosed it at least. Others may not disclose it. Others disclose it in more hidden ways.
Ambiguous ways, which is usually like a earnings disclaimer on their website or something.
Ooh,
that they,
he's oh, I thought you were about to name drop this person.
No, I'm not about to name drop.
Yeah, we're not here to like, if you know who those people are. So we're not gonna, maybe one day if we feel the need to call it out. So in this case, Austin felt the need to call this person out because it was kind of disgusting. And I'll add to that. It was disgusting that this individual took that money, then pretended that they would have some semblance of neutrality. And then, for all we know, their follower base might have put their hard-earned money into that stock and lost a lot of money. So unfortunate, but that's how things go. This is nothing new. Things like this have been happening for the past 20 years, for longer than my career, longer than we've been alive even. It's been going on. So it will continue to go on past today. So
so kind of to my kind of closing thoughts here, and this really goes out to our audience who are watching us.
Also, I want to happy.
Well, first, just be careful about who you decide to listen to. Just be careful about who you learn from. Be careful about who you have in your corner. Be careful about your mentors. Be careful about your friends. Be careful about your significant others, everything, because that will have a significant impact on your life going forward. Now, this is more of the philosophical. Now, the happy part, Fabio, and the happy part is that you recently came to one of my performances yesterday. So thank you for coming, Fabio. I'm sure that you probably really enjoyed that. For those of you who don't know, I play music. That's really a big passion of mine. And Fabio,
whole other side of him. His voice changes when he's singing.
This man, this wonderful man came to my performance yesterday. So thank you, Fabio. Thank you for coming yesterday.
Now, it was a good time.
Fabio, do you have any closing thoughts regarding this as well before I wrap things up here?
I think you put it beautifully about making sure that you're careful where the information you're getting from, and making sure that the intentions of the people you're listening to or who are educating you are have the best intentions in mind. So for example, here on this channel, we created a website. We tried to put as much educational content on there as possible. We're still a small channel, and then we try to respond to as many people as we can, answering questions, negative comments and positive comments. We try to respond to every single one. And we're trying to highlight here that not all, and I'm not saying that if they don't respond to you that they don't have your best intentions, because they might be just a larger channel. We're doing that because we're a smaller channel. But when you want to make sure that those creators have your best intentions at heart and are trying to actually provide value, and also make sure they know what they're talking about, because they could have good intentions, but they just don't know what they're talking about. And they're just, living in the bull market and a bunch of hype investments. So then that's another. So it's two separate arguments: best intentions, and then if they know what they're talking about. So going forward, we will continue to highlight that we think we are providing value, and that we're providing value at a fair level and at free level as well on our website. and that we're trying to be as transparent as possible. And we are going to call out when we see stuff like this, actually from now on, because we were on Christopher Bell's channel, Strongman Personal Finance,
The
which
dude
again,
is a
we
lad.
thank you for having us on that time.
Yes, thank you.
And we think that what he's doing is fantastic because he's calling out these creators or specific creators for some of the things that they're doing. And I think from now on, we might have to join him in that fight because it is getting pretty severe as to the ramifications of these individual creators and what they're doing to people's portfolios and hard-earned money. Because those people will become resentful of the market and might drastically affect their lives for the negative, because maybe they say, oh, the stock market's gambling, and they don't take investing seriously, and then they just leave the markets entirely and they miss out on a bunch of wealth creation. Then we want to reach out to those people and then get the people that want to learn and truly want to learn and don't want to, you know, pay $20,000 to learn how to read financial statements. And get those people. Ooh. And then show them that they can just, you know, learn that more or less for free. And that they can basically become good investors themselves, right? Or tell the people that don't want to, you know, don't have the time, and it's completely fine to not have the time, by the way, to then just or recognize that you may not be good at it, okay, and then go the index fund route, you know, as long as you have exposure, okay. Getting some exposure is good.
Yeah, and to kind of add on to that too, especially with what Fabio is saying, the other issue too with basically trusting people that have vested interests, probably contrary to maybe your own, definitely my own, Fabio, is that will then cause the misallocation of capital, as I call it, which is basically companies that don't really deserve my hard-earned money or our hard-earned money will receive those funds, which is what we're really trying to do here at Capital Mindset, is just to try to show great businesses that are deserving of capital, businesses that are deserving of capital. So with that being said, if you've liked what you've seen here today, please be sure to share our video. It really helps out our channel. Please be sure to visit our website at capitalmindset.org. And then please be sure to like, comment, and subscribe. We're your hosts, Austin and Fabio, and we look forward to seeing you guys again. Take care.